Hey everyone, this is Jennifer Hornick and Bob Palestri, and we are back with two of our favorite mortgage people to talk to you about something that is being talked about a lot right now, which is the 50-year mortgage trend or idea that has just been floated out there. So we'll get right into it. I don't know, Meredith or Mike, if either one of you wants to start us off on what you think about this.
Go for it, Meredith.
Well, I think that it's definitely created a lot of buzz, which for us mortgage lenders is super exciting. We love to talk about what we do and how it affects the market and consumers out there. Personally, I think the reality of it actually happening is pretty slim. That's just my opinion. So definitely none of these are all, not facts because we don't know yet, right, Mike?
Correct.
I've been in the industry 20 years and we have had 40-year mortgages. And I think that even when we had 40-year mortgages, very few people took advantage of them, mainly because the rate is higher on a 40-year. And I presume that the 50-year is going to be even higher.
Yeah.
Yeah. So generally speaking, when we had a 30-year option and a 40-year option, most consumers still pick the 30-year option, right? Now, affordability has changed a bit since those were, popular. So, I do think that there would be people that take advantage of them. But overall, if it does come to fruition, I think it'll be a minority of people because once they see what the interest rate looks like, and how much it affects their monthly payment and how much interest over the life of the loan that they're paying. I think most people will be like, no, I think I'm going to go with the 30 because that was our experience in the past. So we're relying on, history there a bit. So that's what I think.
And that's an interesting thought. I never even thought about the fact that your interest rate's going to be higher on a longer term. So that's an interesting point.
Yeah.
Okay. However, Bobby P chiming in here. So let's think about this. That was back in the day when the cost of the home was much lower. I know on LBI, the $1 million house 5 years ago now is a $2 million house. I know the auto industry is now offering up to 84-month loans. It lowers the cost. I'm a simplistic guy. So a buyer that I think it's going to, even though the interest might be higher, a lot of people, it drives down to what is my monthly nut? And
Sure.
so that's just, I don't want, I have another question. That was just a comment. Question, who authorizes this? Like, Meredith, you said it's not going to happen. Like, why wouldn't it happen?
Well, I think the investors out there have to be willing to buy these loans, right, Mike? Wouldn't you
Yeah.
agree?
So how that works is, again, the big Don the Magic Wand, he came out on TV and said, we're going to do 50 years. So cool, right? and I love the fact that he's trying to do something, that the government's trying to do something to help affordability. Because at the end of the day, whether you live in Florida, New Jersey, New York, on average, your home value since COVID has gone up 42%. We all got kids. It is alarming to me. I love it because we all get paid on it, but it's also very alarming to see how much things have increased, right? Like, how are our grandkids going to get houses? For real, at this level. So what happens is so again, Meredith brought up a really good point. It's a good theory, right? But much like a bill going through Congress, it has to be collateralized into mortgage-backed securities. There has to be investors. Fannie and Freddie have to okay it. It has to be warrantable. There are a lot of things that have to go into this. Now, could it help? Yeah. Two simple words: entry point. That's who it's going to help. It's going to help that first-time home buyer that can't afford now the $350 or $400 or $500,000 home on a 30-year, but they can do it on a 50-year. Now, I have another solution to that, and I'm sure Meredith has been providing these to her clients as well. 5-year and 7-year ARMs. They're back, everybody, and it's the same dang thing where, I have a 5-year ARM right now on an FHA loan in the high 4s, low 5s. Versus the high 5s, low 6s on a 30-year fix. So that same client, I have 2 in my pipeline right now. Literally, I said, look, if you want this house, you need to take an ARM because for the first 5 years, it goes off the note rate. Okay. So I also too used to write 40 and actually I did write 50-year loans like back in the day, subprime world, like they were there. And it was the same dang thing as an interest only. So that's, so if you write a $250,000 mortgage times interest only at 6% and a 50-year loan at 6.25, like raise the rate a little bit on a 50-year, it's effectively the same thing. So what we're doing is, again, it's for an entry point. Now, the people that get in there, I hate to use the word the sell, but if I'm showing them the ARM, or if I'm showing them the 50-year, I'm also showing them the exit strategy, because you don't want to be in an ARM forever and you don't want to be in a 50-year. So those people, right? My manager, the owner of my company, Steve Carpatelli, he always talks about earning potential. So if I'm a police officer today and I'm starting out, am I going to make more money now or in 5 years? If I work at the post office, if I work for most large companies, the thought process, right, is that you make more. So the gain for the consumer, and why I still think it is positive and why I still think we should do ARMs, 50-year loans, any way that we can get clients into homes, is because if we don't, they're renting, and that is 100% interest rate. So if I'm looking at 2 dirty shirts and a pile of laundry, I'd much rather take something that allows me ownership, allows me the feeling to know that it's my home, and allows me the feeling to know that my landlord can't take this away from me in 12 months because they decided to raise the rent. So that's where I feel that these things are going. It's a good entry point, but for loan originators, mortgage planners that know what they're doing, not just sitting in a cold call center, they're going to want to talk to their clients about the next move. If it's a 5-year ARM, look, in 5 years or less, we're talking. Or in a 50-year loan, look, we're going to be speaking in the next couple of years. Let's keep in touch, see what's going on pace with your income.
Yeah. And just to add on to that, I agree with everything that you said. You made really great points there. I also am a bigger fan of doing a 5 or 7-year ARM. Actually, I did a 7-year ARM recently.
Me too.
I just bought a house in June, and I was like, I'm not gonna, get a 30-year loan. My last loan I paid off in 10 years. So, sure. I tend to pay things like as I go because it's based on my income. And I think people have the same opportunities. They can pay extra. But one thing that I wanted to mention just for consumers that are watching this is that, I think that a lot of consumers are very scared of ARMs. The word in itself is a scary word to people. And what they need to understand is that this isn't 20 years back when we had an option ARM where you were negatively amortizing. It's also not necessarily an interest only. These are amortizing ARMs. What that means is that you're paying it like a 30-year loan. It is amortizing principal and interest every single payment. You have the opportunity to pay more. The only difference is that after 5 or 7 years, it will become adjustable. But even when it becomes adjustable, there are caps in place. There is a initial cap for the first year, subsequent caps each year, and lifetime caps on these loans. So they're all protective measures, to make sure that you're not going to be in a really bad way 5 to 7 years from now. But again, when you're working with, folks that know what they're doing like us, we're going to educate you on the pros and the cons, and ultimately it's the client's decision. But I agree, I would rather do a 5 or 7-year ARM than a 50-year loan. I also am a bigger fan of, programs out there to help these first-time home buyers bridge the gap, and we have programs like that here in Florida. Mm-hmm. Not as many people utilize them as they should, as much as we talk about them. We have a Hometown Heroes program right now that had $50 million in it, and it came out in August and it's at 20 million still. That's how many people could be utilizing that program.
Yeah, I agreed. Another thing I'm thinking, Bob, you're at the beach, right? And Meredith, I'm sure you do with jumbo stuff as well. Mm-hmm. I don't know if the 50 years is going to be the end all be all for that, because folks buying jumbo are either well-to-do, let's face it, or they're buying a second home and they're really chilling, right? So they're buying a second home to go to for 2 months or 3 weeks. So I'm finding more clients are going to do that interest only. So Bob,
Mhm.
that interest only on those jumbos, you're absolutely right. That payment threshold for the guy that makes 2 million, he'd rather just have the lower payment. He's never paying this thing off until he wants to when he gets his bonus, right? So the 50-year, I think it's more of a buzz point, and I think it's great for us in the industry to be able to come up with another way for clients to afford a home. But like I said, do I think it's the end all be all? No. If it's me as a planner, I can absolutely tell you I'm going to be pitching the 5-year or the 7-year over the 50-year. Why the hell would I give my client a fixed end higher rate when I could give him a lower rate? All the while knowing that, again, my crystal ball works as well as everybody else's, but I don't think that we're going to be going into a rising interest rate environment in the next 2 years. I'm going to push it out that far. I don't want to go past that. But even in the next 2 years, do I think we're going to have 8% as a start rate? I certainly don't.
Before we get into, I did want to ask you guys what you think about what is going to happen with interest rates. But I think an important point that you both are making is that as a consumer, as a buyer, please do not make assumptions. Get on the phone with someone like Mike or Meredith. There are so many programs, there are so many options. And, as Bob and I, as realtors, we don't know every single option that's out there because there's constantly things changing in the industry. And you guys are such a wealth of knowledge to help people understand all of the options that they have. So there may be somebody sitting there today that's like, I can't afford to stop renting and buy, but yes, you might be able to. So have those conversations before you make that decision.
Before you jump into, the rates, one of the things that I find really funny, because I did multiple videos on this last week and lots of commentary, people giving me their 2 cents, and that's great, because that's what it's all about, is, getting people engaged and talking
Sure.
about these different topics. So I welcome the comments, whether I agree with them or don't agree with them, I still welcome them. But, I find it really funny that people have no issue whatsoever paying 20% or higher on a credit card. They will lose their minds on paying higher rates or doing a 50-year mortgage potentially. I think it's just hilarious. Like a lot of these people, I promise you, that are commenting on my pages, they're literally paying 20 to 25% on a
They're
credit
getting
card.
the margarita mixer for Christmas and the sword because they needed it.
It's a mindset.
It is. And when I tell people, no matter what mortgage you decide on, you can always pay more.
Yes.
I don't care what the amortization is.
Which effectively lowers your interest rate, because if you pay it back fast, so like you paid your loan off in 10 years, it'd be interesting to see what your actual rate was over those 10 years, because you just rock'em sock'em roboted it and beat it down. So I commend you for that. I think that's
thank you. Well, yeah, I mean, I think it's just about, doing what you can when you can, because I couldn't always do that. I had 3 kids in college at one time. And if you think there was much extra going to mortgages, no, there wasn't. But once I got them through that, life cycle, then I started aggressively, paying it even more. But it's all about choices and options and education, because you don't know how many people we sit down with at closing that have no idea if they make one extra payment a year, whether, they do it all at once or they divide it by 12, that on a 30-year mortgage can take like 6 to 7 years off of that mortgage. Right. So, a lot of people just don't have the knowledge. And again, that's probably why we're doing this podcast, so we can educate more people.
Absolutely.
Yes. Bob, did you want to ask anything about what we see going on in the future?
I just want to backtrack because I'm slower than the rest of the group. So did I hear that if a client does a 5 or a 7-year ARM, those first years are interest only? Is that what I heard?
No, they're just a lower rate. Yeah.
Yeah, a traditional 5 or 7-year ARM is amortizing just like a 30-year loan. It's only if you do the interest only option. There are interest only 5 and 7-year loans. So those are really 2 different products.
Okay. So for the person that really wants to drive down their monthly, I'm sure the interest only is a higher rate, but
they don't care.
Yeah. Okay, good. Okay.
because they're paying it back. They're doing what Meredith did, just on a grand level. They're
Okay.
going,
I get it.
you know, I lent somebody $3 million on Long Beach Island last year. The guy makes like $100 million a year. Like he's just like, you know,
Yep.
it's like a credit card to him. Like he does. I swear, I think he did it because he likes me. He's like, yeah, you know, like, so for that guy, he's got 7 7/8 on an interest only, and he can do whatever he wants because he's the man, you know. But he
That's
takes it
pretty
as his tax deduction. Again, why do the wealth stay wealthy? Because they know the tax loop, because they understand.
So
And you know, I can't beat him up for that. You know, that's you know, he has a beautiful house, and he gets a tax deduction of 40 grand a year for to
Well,
own
get
a house.
yourself a good accountant.
Yeah, right.
Yes.
Exactly.
One thing to mention though on interest only versus you know, a 5 or 7 year or 30, 40, 50 year loan, an interest only loan will re-amortize every payment. That's the cool thing about interest
Yeah.
only, which I've had an interest only in the past. I don't right now. But what's really awesome about it, like for someone like Mike or myself, you know, that are in realtors for that matter, where we're commission based, you know, we may get a chunk of money, you know, 1 month. And if we put, you know, $20,000 down on that loan, the next payment is going to re-amortize. So your new interest only payment will be based on that lower balance. That is not the case on a 30-year or any type of
mhm.
amortizing arm,
Yeah.
because it's amortizing. You know, each payment is principal and interest. The only way that you can re-amortize those types of loans is if you do what's called a recast.
Mm-hmm.
And with a recast, you generally have to pay a fee, and there's rules and requirements with it. And not all loans are able to be recast.
Mm-hmm.
For example, a VA loan does not have a recast option. So those are just some differences. So sometimes, like, especially people who are commission based or uber wealthy, like Mike said, they may want to do interest only because when they make a $50,000 principal reduction to it, their next interest only
Huh.
payment is going to be lower. Does
So they
that make
don't
sense?
have to refinance.
Yes, excellent, excellent. So I know we're limited on time for attention spans. So I guess one of my questions would be, where are these rates going? I did hear someone on an airplane talk about affordable mortgages. I don't know if you have a comment on that, but I'm more interested in, I know you don't have a crystal ball, but where are we going with rates?
Go for it, Meredith.
Yeah, I mean, I think it's still going to be pretty bumpy. I'd like to see like what happens in December, you know, with the Federal Reserve, and kind of get into the new year before we make any huge proclamations, to be honest with you. But I think that, you know, we will see them decrease slightly into 2026, but I don't, you know, I don't think it's going to be anything monumental, to be honest with you. You know, to be fair, if we go back 2 and 3 years ago, I have clients refinancing that closed at 8 and 8.125. Those were the highest
Me too.
30-year rates that I, you know, had closings on. And then if you go back, you know, even, you know, a year ago, I mean, rates we're at a 12-month low.
Mhm.
We're excited in
Yeah.
our industry. You
Yeah.
know, I think
I get it.
my personal opinion is the further we get away from 2 and 3% rates, the better.
It's the new norm. Higher for longer.
Yes.
It is what it is.
Yep.
Last year at this time, I had people that didn't want to refinance because they thought they were going to drop. In full disclosure, I wasn't aggressive enough. I should have been pushing more. I'm a pushy guy, but I didn't. And then those people blew it. And those people are coming to me now, and they're just saying, hey, if you get me X. So I am 1,000% with you, Meredith. I think it's higher for longer. I don't think that rates are going to drop through the floor. And if you're saving $300 today and the difference in another eighth is $40, do the math. Again, I count on my fingers, but do 300 divided by 50. That's 6. So that means if you wait 1 month and don't save $300, that means that eighth of a point, like that's 6 months worth of waiting. Like it's just the numbers. That's why the little, the consumer always gets squashed, right? Like, so I am a huge advocate of not waiting to either refinance or purchase right now. I do think now in New Jersey, we are still very strong in our market. In other states, not so much. But I can tell you that as these rates drop, that inventory is going to get sucked up. So for anyone on this call, if you live in an area that isn't as hot of a market and you think I'm just going to wait because you think that the bottom's going to fall out, I can tell you you're wrong. I can tell you that renting is 100% interest rate. And I can tell you that a wise man told me that you don't buy a house to get rich. You buy a house to live in it and enjoy with your family. If it's time for you to buy, stop listening to your dentist. Stop listening to that person on the airplane. Get informed, get educated, and make your decision.
Yeah, I wholeheartedly agree with everything that you just said. And in, you know, Florida market, the concessions and things that are available to buyers right now is unparalleled to anything that we have seen in years.
Mhm.
And it mathematically, it does not make sense to
I think
wait.
it's short-lived. Yeah,
I think it's
It is
short-lived.
short-lived
And
because I think we're about to have a lot of people coming and snapping up this inventory that we have right now.
Yes.
So
I
take
think so
advantage
too.
of it while you can.
Yep. I very much do. I very much do.
Did you have anything else, Bob?
No, no, no. Thank you. Thank you.
Thank you guys so much. This was super educational and helpful as always. Meredith.medvec, Mike Carvajal, their contact info will be linked right below here for you guys. Please reach out to them. In New Jersey, Mike, he also does Florida, and Meredith is in Florida. So thank you guys so much. And we will talk to you again soon, I hope.